Yeah, every year you have to sell more and more and more and more. To build a 100 crore business, you have to sell immensely.
It's not technology, but it's sales, which is going to differentiate who will win.
Businesses like Flipkart, Meesho, Amazon are so sort of awesome. The lifetime value is just immense. Once you're on these platforms, you just keep buying and buying and buying and buying, even if it's small ticket. I always think that my entrepreneurship journey started from a conversation that I overheard from Newgen founder. So I always think that hopefully someone will hear this and get inspired, and hopefully we'll have more entrepreneurs.
Of all the venture capitalists that I've interviewed till date, I found that I could put them into two categories. One is somebody who looks at his role as financial services guy. He is managing wealth of people by directing it into startup investments. And the second kind of VC is somebody who's there for the entrepreneurs, who's there to help entrepreneurs build large businesses, get amazing outcomes, move the ecosystem forward. And someone like Rajul Garg is strongly in the second camp. You would hardly find a more qualified venture capitalist than him in India. He has built some of the biggest names you would have heard of. Pine Labs is planning to do an IPO soon. It is a rare fintech which is profitable, a couple of $1 billion of valuation. Global Logic was the other company that he started. Global Logic was acquired by a Japanese company for $10 billion approximately. And the third company he started is Sunstone, which is really taking a very ground up first principles approach towards fixing the employability problem. Completely, I would say, like an anti-edtech thesis that they are following, and I'm sure it would also be one of those large outcomes soon. And now he is the managing partner of Leo Capital. Superb conversation, learned a lot from it. I'm your host Akshay Datt, and you're watching the Founder Thesis podcast. I want to kind of understand your origin story, and just take me through, like connecting the dots of what made you an entrepreneur in terms of the things you saw growing up, which inspired you to do that.
So I wouldn't say it started growing up, but I grew up all over UP. My father was in a government job, so transferred all through the nicer parts of UP. But I think my journey, professional journey, in some sense, only started when I went to college, which was IT Delhi. This was 1994 to 1998. And actually, the first time I learned about entrepreneurship was that my roommate at IIT Delhi, his uncle was the founder of this company called Newgen Software, which was a fairly large company in the 90s in the software space. And he had come to our hostel and he was talking to his nephew, and talking to him about entrepreneurship. And I kind of overheard because I was a roommate. I mean, I sort of joined the conversation. So I thought that this is really cool. And I before that I don't think I really knew the word entrepreneur. I knew business, like I mean, like you see small shops and all that all around you, but I never knew sort of the concept of entrepreneurship. So that's what I think. That's where the seeds were sown in my head. And when I graduated in '98, I actually became an entrepreneur right away. It was a bit of what they say, there needs to be motive and opportunity. So I was motivated. I was kind of thinking about it if I could do something. And there was an opportunity that came by that somebody I knew, actually a cousin of mine, he was working for this company called Schlumberger. And Schlumberger, we all know the company from an oil field perspective, but they also had like a what they call a division called test and transactions, in which they were trying to sell chip cards, these SIM cards, basically in India. And while they had the cards, but they didn't have any software or solutions that required these cards. So it was like a solution looking for a problem. So they, so they thought, I could write some cheap software. I was kind of fresh out of college, and they sort of, through my cousin, commissioned me to write a small software for chip card software. Which later became Petrocard and later became Pine Labs. So that's just kind of the origin story. It was I did obviously have a job offer when I graduated, and so I think I remember like there was a big decision point. This was 1998, so this is prior to all the VC funding and all the things that happened. and I decided to kind of become an entrepreneur versus taking up a job. So I do remember it being like a deliberate decision at that point of time. But that's basically how it happened.
This was you started as a solopreneur. You were alone, or you.
I had a co-founder, Tarun. He was in a 5-year program while I was in a 4-year program. So he was only able to join full time the following year. But he was very much a co-founder, right from day one.
And how did one project to write some code become a business? Just take me through that evolution journey.
Yeah, so I think just the multitude of decisions also, like in India, I would say the salaries for software engineers were quite low at the time. So, for example, the normal salaries that if you were to join in India at that time was about 2 lakh rupees a year for my batch. It ranged from, let's say, 1.5 lakh to 2.5 lakh, depending on where you join. So, and I didn't want to go to the US at the time. Again, that was the other option where you could get better salaries and all that. But so I felt the opportunity cost was low. I felt it's like, it's 15, 20,000 rupees a month. I'll figure it out how to make it. And that did play a part. I thought, okay, I'm not giving up that much. I'll come back, in a year or two if I have to do something. This first project that I did was like a 10,000 rupees software coding project, 3 months, 4 months. And what it entailed was that, in Delhi, so basically, Schlumberger, when they were selling these chip cars, they were trying to sell them to petrol companies like BPCL, HPCL, and they wanted to roll out these prepaid card. BPCL wanted to roll out this prepaid card, where you could load money on a card and send them to a petrol pump. So, like for example, if you have a driver, you load 500 rupees on the card, he can spend it there. Like a closed loop solution. So it was not available anywhere outside the BPCL system, uh, but very much a part of the BPCL system. So this first project was the first pilot of that for one petrol pump, which is like close by where I am right now. There's a Mulchan flyover in Delhi, and there's a petrol pump there. So this was meant for the first petrol pump, and that is what I was commissioned for, and I wrote the software. But what happened was that one petrol pump led to a fuller rollout over a period of time. It became multiple petrol pumps, then became a BPCL wide rollout. The chip card project grew into other branches. So there was opportunity to do more just within that same project. I could see that will lead to more, over the next 2, 3 years, and at least give me some sort of income and revenue. So that's basically how, it kept on evolving, and I just kept on working on it.
This kind of reminds me of the Bill Gates origin story, where IBM uh, decided to structure the deal of giving him a license per Windows software installed on a machine, instead of paying him a one-time cost to just write the Windows software and sell it to them lump sum. Was something similar happening here? Like it was not a
I
one-time project to write code and sell it to them. Uh,
it started with one-time code, but actually I have an interesting, since you make that parallel, over the next couple of years, actually, as we rolled it out in BPCL, we did in fact have a deal which was a per chip per month type of revenue to me, to my company Pine Labs. It took 2, 3 years before it happened, as the rollout happened and things like that, right? So in that sense, it's quite similar. But I think it didn't end the same way, because what I realized was that in India, again, I think what ended up over the following 5, 10 years is that the end customer, which is BPCL, ended up renegotiating these contracts. So it started with a certain amount of money, let's say 5 rupees per chip per card, because they expected a certain amount of rollout. And then, as the cards grew, they actually renegotiated it. So what ended up happening was that every year they would renegotiate it, so that the money that we were getting was actually became quite fixed. It never grew, because they would say, hey, you're a small team. What will you do with so much money? You're making too much profit, and we didn't have much leverage. So it was
okay.
actually also a learning for me when I sort of now look at large enterprise contracts. I think particularly in a place like India, one has to look at the true leverage that one has. It's very hard for me even until today to believe that a large enterprise will keep paying you large amounts, as license fee, which is very common in the US. And I think maybe now I see some fintechs, I'm sort of going a little bit all over the place, but just to connect the story, now I see some fintechs charging large money from banks and things like that. But my experience has been that unless you have very solid leverage of some sort, customers end up renegotiating these contracts big time. So you never sort of really meet your projections or really sort of have the Bill Gates story come true in India in that sense.
Mm, fascinating. Your customer was Schlumberger or BPCL?
So my customer was Schlumberger for the first few years, and then over years, actually it was always Schlumberger. So it was through
Okay.
Schlumberger, and then but
Okay.
at some point I think it became like some sort of tri-party contract as well, because
Okay.
they were more interested in selling hardware against all the chips and terminals, and I think they passed on the software service contract directly at some point, over years.
Uh, what was your scope of work here? You were just to write the code, or were you also kind of project managing the whole petro card or the fuel card initiative?
So I think they were whole, like if you look at the overall Petrocard initiative, it ended up being a largish initiative. So BPCL had a full dedicated team over years, right, which was sort of the project management office. You can see a program office. I remember the guy Rakesh, he was running it. So that from their perspective, there was a lot to be done, right? So train their petrol pumps and operations and deploying terminals and service and maintenance, and then Schlumberger was actually took the solutioning role of this how whole this thing will work, and combined with me to actually do both solutioning and then ultimately software development. But I think largely I would say it was software development, some solutioning, some consulting, sort of how things will work, how they will not work, what is possible in technology, what is not possible in technology, things like that. But largely on the technology and the software side.
How did the redemption, like how did they use the card through the existing point of sale credit card machines, or you had a
No,
special
this
machine in every pump?
it, so this was the first version of the what we see as the point of sales machines today, the credit card, the finalized machines that you see. So basically Schlumberger, as a part of the test and transactions division, had a card and they also had a machine. So
Okay.
the machine was basically they sold the machine to BPCL. So BPCL deployed the machine. They sold the cards. The card was inserted. It was a chip card machine. So this was the first generation of chip card machines in India, because prior to
Right.
that it was all that swipe card basically, right?
Magnetic
And
strip. Yeah.
magnetic strip. And I don't know if you've seen that word, but prior to that there was also this kitch catch manual machine where you took an imprint of the card. The merchant used to call the bank by phone and
Okay.
take an approval.
Wow.
But I
I haven't
think
seen that one.
you haven't seen that. I think that's actually
Mm,
quite cool. So I think
mm.
so there was this swipe card machines, and Schlumberger's pitch was to try and replace the market with the chip card machines, which they had, and they wanted to sell a whole lot of those. So that was their business model. So it was a involved rollout. You buy the machines, you roll out the cards. The petrol pump would sell the cards to you and me as end users. Then we'll load the card, then we'll buy the card, and then PPCL will give you loyalty points also on top of this, right? So that you basically keep coming back to PPCL versus, let's say, HPCL and IFCL.
And this was on the cloud, because again, cloud was not a thing back then, right?
So
Like in terms of
cloud.com
balance.
Cloud.com, yeah, the cloud term was, I would say, just coined around that time in 1999. So
Okay.
if you know
Okay.
Ben Horowitz, right, the A16Z, his company was called Cloud.com, and he started in '99. So
Okay.
so that was the beginning of the term cloud. Internet itself was fairly new, right? So internet itself came 95, 96, kind of it became main. Internet Explorer, Netscape came in 95, and the Internet Explorer came, right? So I think the cloud became mainstream much later. So this was all pretty much client server. So there was software on the terminal or the machine that sort of took the card, and in the back it was all client server like BPCL, and there was these Windows apps through which they could see reports, they could manage, right? And then there was a network provider through which the transaction flew. So it was a fairly sort of what they called two-tier architecture. Later became three-tier architecture at that time. Yeah.
What are these terms? Two-tier architecture, three-tier architecture.
Historically in the 90s, software was just like this. There was like a database, right? Like a SQL server or something, right? And there was a Windows application, and the Windows application would directly talk to the database. So that was called a two-tier architecture. So this is how sort of the whole, form-based Oracle forms and Windows forms-based applications came in the 90s. And then later on, then all these application servers came, which provided a middle layer. So basically, the client application would talk to the middle layer, and the middle layer would talk to the server, and provided more modularity. And you would have heard these kind of things. So it became three-tier through
Okay.
the sort of early 2000s. And I think, and now today, I think just fast forwarding that, we are in the Kubernetes and container architecture. It's the evolution of the same basically thinking, which is to modularize every component so that every component can be scaled on its own, and every sort of, you can have specialists in each part of that whole, but ultimately it's all query, edit, save, right? You're basically putting things in the database, extracting it, reporting, all that same stuff.
Fascinating. Okay. Um, you were largely like a product head kind of a role, or were you like managing the business, or like what was your role in Pine Labs?
So I was the CEO, from nomenclature perspective, right? Founder and CEO. But I was really, really a techie for the first, at the beginning of the company. I had no sense or idea of, let's say, business or what a product is or what a solution is. But through the years, as we started deploying, I became aware of business, of like how does this make sense for BPCL? How does this make sense for Schlumberger? How can it make sense for us? And I would say, I started, so I became what I would say more of a general manager, where I would sort of understand sort of the business aspects, but continue to provide technical because I was a techie, grown up a techie. So techie turned CEO, you can say, in some sense.
Okay. Okay. Okay.
Yeah.
Uh, were you able to solve the problem of not having leverage?
Not really, I would say. It was very challenging because we didn't have any sort of either equity or debt of any kind. There was no leverage of any kind, right? So, for example, even getting paid, from Schlumberger, BPCL was challenging because, Schlumberger would pay us when only BPCL would pay them. And it was like sometimes it would take a long time. The good thing was that our costs were very low, so I think the one-person team became two when Tarun joined next year, and then we became five. We hired a few people, and I remember we took up a house here in Delhi in Malvi Nagar. So the drawing room used to be the office, the bedroom. I used to live in that. So the costs were really low. Maybe our entire expense was like less than a lakh a month. After a year or two. So, but I do remember, requesting Schlumberger to release payments, going back and saying that, okay, can
Right.
you please pay us? I have to pay salaries, things like that. So this was very
Yes.
common in those days. Yeah.
Right, right, right. Yeah, I mean, yeah, Indian MSME, every Indian MSME knows this challenge of getting paid. Uh, I guess today Pine Labs is possibly the highest valued fintech in India, or somewhere in the top five at least. Um, so I have two questions here, really. One is that what made you leave that journey midway? And second is what happened for Pine Labs to build that leverage, or how did it reach where it is today? And you can
Yeah.
answer in whatever sequence you want to.
Yeah. So I think the story is, so as I mentioned, I started in 98 and Schlumberger was our main customer. And there was this guy at Schlumberger, who his name was Lokvir Kapoor. And he was actually sort of, I would say, he became the overall program manager for this entire thing. I mean, in some sense, he became part of that brain trust, who was running this program, who had the budget, he was paying us and things like that. So he was like a senior guy. He was ITIM, I think, in the 80s, early 90s, so he was like a very seasoned operator, had been with Schlumberger for 10, 15 years, so knew all the business aspects and things like that. So I started hanging out with him a lot, and he, I would say, started liking what we were doing. And he had his own entrepreneurial ambitions. He was thinking, can we take this out? And he had certain ideas that why can't Pine Labs do this directly? right? Maybe get into credit card applications, maybe get into loyalty programs. There was a lot of possibilities that he saw from his vantage point because he knew the ecosystem much better. So him, I started chatting, over those years, and then eventually he joined Pine Labs as the CEO in 2003. So he left
Okay.
Schlumberger and joined Pine Labs as the CEO, which I would say was like a big achievement, for me. I mean, I didn't know all these terms back then, and sort of this was unusual, right? But I could see that he was just much better equipped to take Pine Labs, build Pine Labs, in a certain direction than I was, because it was way above my, not just because of, I think there's certain kinds of products, like for example, if it's a product like Calendly, let's say, I'm just taking a random example, right? It's a simple enough product where like a product manager can run it. There is not like a lot of ecosystem play. You build a good product, it's selling it on the internet, things like that, right? But this was a very sophisticated, complex ecosystem play, right? You needed banks, you needed petrol companies, you needed Fortune 500 companies, right? You need to conceptualize solutions. So this was way over, I would say, my pay grade on understanding at that time of how this can be run. And he got it. So I think so he joined. When he joined in 2003, we were still small as a company. And actually, I would say he practically built it over the following 14, 15 years. So he was there until 2017, 18. I think he ultimately left after that. So he became, in some sense, the key guy, building it up over many years. And hence, I think in 2008, when sort of Sequoia invested in it, in Pine Labs, Sequoia India at the time, there was an opportunity to sell. The company was still small at that time. It was not very big. I forget the valuation, but it was, less than 50 million. Let me put it this way.
Okay.
So I think it was still early days, and they came in, and so I sold at that time, and the cap table was kind of reorganized at that time because there were other people coming in. Actually, the guy I mentioned, Rakesh from BPCL, he joined Pine Labs as well over here. So after Lockheed
Okay.
came, he attracted. So we moved upstream, right? Kind of went more towards the customers, who understand the program, and so he joined, and that became the leadership team, of Fine
Okay.
Labs. So I
Yep.
sold my stake in 2008 to Sequoia when they came in. So actually, my involvement ended then. I wasn't a shareholder after that, but I do know that one of the things that changed big time for them to make them what they are today is that for many years until 2013, 2014, they were a service provider to banks and to, let's say, Schlumberger type of companies. So they pivoted from the petro card to credit card. And for credit card solutions, they were providing these solutions to banks. So for example, they would go to ICICI Bank and say, you deploy credit card terminals, we'll provide the solution, we'll provide the software and things like that, right? And there they could never take off. It was just, banks, again, back to my first point where like BPCL renegotiated, banks always renegotiated. They never paid too much, to a service
Right.
provider because, they were the ones taking the risk. I think around 2013, 2014, just before demonetization, I think, they kind of became competitors with banks and went directly to merchants. So they said, we will deploy terminals at merchants and we will enable what is called a multi-bank terminal. So on my terminal, I'll have ICICI Bank, HDFC Bank, Yes Bank, whoever else wants, and we'll route the transaction and we'll make the money first from the merchant. So I think that was the big pivot, and that enabled them to really deploy rapidly across merchants in India. Obviously, more risky as well because they had to incur higher cost. But then we had Sequoia by that time, so we had more funding and all that. So that I think really exploded them into the scale that they are today. And then they added more features on top of that, things like lending terminal, lending opportunities, and a bunch of other stuff over years. And now obviously Ambrish is doing a lot more. So I think so that was the journey. But I think the big pivot was taking on the banks versus working for the banks.
Okay. Fascinating. So essentially, Pine Labs decided to own distribution instead of
Based,
the bank distributing the machine. Pine Labs decided to own the distribution, and instead of charging a fixed subscription per POS terminal from the bank or something of that nature, they decided to take a part of the MDR. Essentially, they moved away from being a tech business to a distribution business, from what I understand then.
absolutely. Yeah. Yeah. Correct.
Okay. Is there a learning from this for founders in general in terms of being a product company versus being a distribution company? Or
I think the learning which I learned, and I now see actually many of our portfolio companies learn, and I've seen this repeat many times, is that, compared to, let's say, the US, in India, it's extremely hard to scale like a cutesy tech business, where you say we're just providing a cool piece of technology and people will pay us a licensing fee for it. It's very hard to scale it beyond a point, because I think the pricing is low. Customers are unwilling to pay, based on ROI. They want to pay based on cost, because people think of, okay, we can build this ourselves, even if it's a cheaper, shabbier alternative, but people would go for that. When I say people, I mean enterprises, versus paying high license fee to companies. Hence, I think if you're on the revenue side, where you can control either revenue for them and you get into that line, you're much more likely to scale, which becomes like distribution. So even if you look at, let's say, the modern fintech companies, right? You look at, let's say, last few years, like Jupiter or Uni and some of these like largely funded companies and many others, right? One simple way would have been to just provide technology to the banks, right? Because the banks are already there. But I see
right,
how hard that is to scale. So many of them launched these co-branded cards, right, or co-branded products where they took on the distribution burden. Said, okay, we will
right.
distribute it, bank will be behind us, right? Which is basically the same strategy, because it's, theoretically much, you can scale much more. You can actually get paid from the customer and then pay the bank, because the moment you get behind the bank historically squeezes you big time. And then it's very hard to build a venture scale business. Now, there are some exceptions. I see now, for example, I read, I don't know about M2P, for example, but I read about it, that they're like a technology provider, to banks and providing the
Oh,
stack. And
they
I
also
see,
take the MDR only. I mean, they're
yeah,
also earning MDR.
there you go.
Yeah.
There you go. So I think if you're
Right.
providing a
Yeah.
simple versus in the US, let's say, for example, we see many companies who are, let's say, providing technology to a Wells Fargo, JP Morgan, Goldman Sachs, and charging millions of dollars. And in the process, like, for example, if you look at a company like Snowflake, Snowflake makes almost like several $1 million a year from each bank that they sell to, and banks are okay paying that. Snowflake can do just that. They would never dream of getting into distribution or MDR, right? Because that's bank's business, right? But in
Right.
India, we see companies getting towards distribution to get a larger share of that pie, because the license fee is not enough to build a large business.
What would be your advice to a founder of a product business? Like, say, we spoke of Calendly as an example. So, if someone is building a product per se, like, what would be your advice to them? Like, keep it a lifestyle business, don't raise funds, or figure out a way to become irreplaceable. Like, what would be the way to build a large product business?
If you're a B2B business, if you're a SaaS business of some sort, I mean, I think the examples of success from India are the companies which have scaled more globally. So whether you look at Zoho, which is now at billion in ARR, right, or you look at Freshworks, or you look at sort of many Project Stack, Lambda Test in our portfolio, more recent successes, the Noti, all these companies derive a vast majority of their revenue from global markets. So that's kind of the thematically what entrepreneurs are doing today. So they globalize much sooner, because they realize that they can make these licensing fees. If you want to do just fraud, if you want to do just India, chances are that you will have to end up doing more. If you really want to scale, you'll have to get into distribution, you'll have to get into something else, solutioning, right? And basically get into that. It's very hard for me to imagine even today, that companies can really scale to, let's say, hundreds of millions of revenue just doing software. I mean, there are hardly any examples of that. Like, even if you look at something like Tally, right, which entire India uses, right,
Right.
forever, right? Even that, from my understanding, is they're about 100 million in revenue. So think about it, right? That's kind of the highest end of software only, right? A company which has been there for 30 years, everybody uses it. That's the highest end, at least today.
Yeah. Yeah.
And then venture funded companies, I know of companies which have now raised, gotten to 20, 30, 40 million in revenue, but that's kind of the extent of it. And this number used to be 5, 10 million 10 years back. So it has
Mm,
gotten better. And maybe if you fast forward 10 years, more of these opportunities come up, but they're still few and far between.
okay, fascinating. So, okay, we've covered the Pine Labs thread. What did you do next?
So, so around 2001, when I was kind of in the middle of building Pine Labs, I met a couple of more people, Sanjay and Manoj, and they came from the US. They were sort of connected through like an IIT connection and things like that. And they came to Delhi and they were carrying this Mary Meeker's report. I don't know if you know Mary Meeker. So Mary
No.
Meeker used to analyze the internet, and her sort of annual report was like the Bible of what's happening in the technology sector for many, many years. She was working for one of the analyst firms, and she became the ultimate word in what is happening in technology trend. For many, many years, so people used to wait for her report every year of what's going to happen. And eventually, by the way, on her story, eventually she started a fund called Bond Capital a few years back. The Bond is like a massive sort of fund that she started, based on her credibility as a researcher and of technology trends. So in
Mm,
2001, she predicted that sort of B2B technology around supply chain integration, something called XML, will take over the world, and it's like the next big thing. And these guys, Sanjay and Manoj, came to Delhi. They were having a copy printout of that report, and they're looking to find co-founders, of a business that they wanted to start, in the B2B space and in the technology space, basically building XML-based products. So we met, and by this time, I was 2 years building Pine Labs. Right, this is actually 2000, not even 2001. This is like summer of 2000. So I think so. I built Pine Labs for 2 years, and I had sort of sensed that how hard the business environment is, and also that maybe I'm not the right guy, because of the whole ecosystem and payments is an issue and this and that, right? So while I saw the opportunity now more clearly, but I also doubted my own sort of capability to capitalize on that opportunity given the complexity of the whole thing. So I found this whole B2B product, XML, very tech, very tempting. I felt this is like a good where I can really put my tech skills to use, and I can, build products, and we'll build this global. Mary Meeker is saying it. This is the next big thing, you know. So we basically then combined, and we started what eventually became Global Logic. So Sanjay, Manoj, Tarun had joined by this time. Tarun and I, started Global Logic. We became four co-founders. And actually that's also further triggered the process of getting Lokveer on board. So discussion with Lokveer was also going on in Pine Labs to take over the CEO, which eventually took a year or two. So he joined in 2003. But I think that whole thing came together. So four of us became founders of Global Logic. Our first name was EB Provider, E Business Provider, because we were doing this e-business integration, so we thought that's a good name. So that's how basically the Global Logic story started. I kind of ran both in parallel for a couple of years until Lokveer joined. But my focus then changed more and more towards Global Logic. So that's how the EB provider / Global Logic story started. Just to complete the story,
okay.
by the way, Mary Meeker was completely wrong on B2B integration XML. It completely blew up in the following 1 year, 2 years. I think this is one of the
Okay.
one of the things that she got wrong. I mean, she got a lot of things right, but this is one of the things she got wrong.
Uh, I'm not very clear on what was the business that it was doing. It
So
was
think
a
of,
you said XML products, so it was a product
yes,
business or
it was a hardcore product SaaS business. So think of it this way:
okay,
that have you heard of this company called i2, uh, which was a big supply chain integration company in those days, also an Indian founder. So think of it this way: that if you take a large enterprise, right, any enterprise, BPCL again, they have a lot of vendors, right, who supply them stuff, and they have to send them information. They send them information. So there was this whole movement of standardizing how that information goes, and then automate the entire supply chain, and XML was kind of the protocol on which all of this was getting built. So our product, which was called X Integrate, was basically meant to do this. That if you want to, give more visibility to your vendors around your supply chain and get visibility from them on when your goods will come and things like that, then you establish this language with your vendors. So our software has to be deployed, at the enterprise, at the vendors, and again, sort of in the overall ecosystem to provide better visibility to everyone. And then XML is the language through which all these systems will talk, kind of machine to machine conversation, and give better insights and bring more efficiency into the supply chain, which theoretically is actually makes a lot of sense because obviously, the more information you can give, in the ecosystem, everybody can operate better. But practically, it's very hard to do because it requires like an overall change. Only one company can't do it on their own, right? I mean, so you can take, for example, textile supply chain and go into it and automate the whole thing. I too did a very good job, became multi-billion dollar company, got bought by SAP. We thought we'll go the I2 way, but the market completely crashed in like 2000, 2001, and then 9/11 happened. So it was like a complete sort of, it never really took off in our case.
What did I2 get right? Why were
I
they
think they,
successful?
I think they were ahead of us by a few years. So they started in mid 90s. They were a US company, well capitalized. I think the guy who ran it, I think I met him many years later, Ramesh Wadhwani and Sanjeev Sindhu. I think they were also much better equipped to run this, I think, versus like four Indian kids, sitting in, Delhi and Washington, D.C., and they were a few years ahead as well. We were late to the party for sure. By that time we started, the party was already kind of getting over. I think IT got sold, within a couple of years of we getting started for multi-billion.
This also sounds like an ecosystem play, because as you said that you have to kind of get large scale adoption within one niche for it to add value.
Absolutely, it is, and I think again, I underestimated it. I mean, I thought it's more like a product. It's again not a Calendly type play that you just put a product out there and do something.
Mm,
It is again sort of more complex. There's system integration involved. You have to visit the company and do all that. So I think you're absolutely right. I don't think I thought it through and sort of, that it's really sort of. I was looking for a more tech product. I thought this is what it is, but it wasn't.
mm, Okay. This is also called EDI, right? Electronic Data Interchange or something like that.
Yeah, so EDI is a, let's say, electronic document interface is like a larger bucket, which is both within the enterprise or outside, like even within the enterprise, when you exchange documents with each other, it's part of EDI, So
Mm.
this fell into the whole SCM. If you take the larger bucket was supply chain management, supply chain integration, that's what it fell under.
Okay. Okay. Did you go after a specific niche? Because it sounds to me like this business will work if you dominate a niche.
Yeah. So, honestly, we just roamed around like headless chicken. So we started in 2000, four of us. We raised VC funding, so VC funding happened to us in December 2000, 6 months after we started. And this
Wow.
was
And
actually
this was
raised
an
in,
Indian VC, or because I don't
this was
think
a
India had
US.
VCs.
India
Yeah.
didn't have VCs. So our company was headquartered between Washington, D.C. and Delhi. So I was in Delhi. The other two founders were based in D.C. So DC had an venture ecosystem, and we were funded by Draper Atlantic. So Drape, you might have heard of DFJ. DFJ is like a old time VC firm in the Bay Area, and they had started expanding to other parts of the US at that time. So they started an East Coast affiliate called Draper Atlantic. It was kind of after the Atlantic Ocean, and basically Draper Atlantic put in like a $1.5 million seed check, in us in December 2000 because they believed the same Mary Meeker report and they believed in XML and our ability to write XML code and build software around XML. I remember we were going to XML conferences and talking about our XML capability, basically. So we were coming very bottom up at it. We were like, okay, we'll build tools around XML. We honestly didn't know how the go to market will work, how we will take it to market. So actually, for the good part of the first 12 to 18 months, we kept on building excellent products. I built out a team here in India, in Delhi, and I think we built a fantastic team. A lot of that team did very well over years. But I don't think we did a good job of understanding the ecosystem, taking it to the market, in the way that you said. That would have been the right strategy, to take a
Mm,
vertical, really go after it. But we were more horizontal. We were selling tools, and it never really took off. Yeah.
mm. Okay. Okay. Uh, your role also, I can see, changed while you were within Global Logic. I guess earlier on you must have been more of tech, and then you went into a different role. Tell me about your own journey within Global Logic.
Yeah, so in Global Logic, I was what you would call the COO, Chief Operating Officer. So my responsibility was basically to hire engineers, build product, and work with customers on deployment and things like that. So I think the US side, Sanjay and Manoj took over all the sales, because they were in the US and we were selling in the US. And Tarun was sort of the CTO, solving hard technical problems wherever we got stuck. So my role was basically CEO, putting the whole thing on the road, and all that. So I think we grew the team, through 2000, 2021, 2001, 2000, 2001, to 30 engineers. We took up an office here in Delhi in Srinivaspuri after we got venture funded, and sort of, built out the team, built out the product. So my role basically suddenly changed from what you would say like a techie running small team tech lead, to what you would call later like a project manager, truly, where engineering manager, you can say, hiring teams, putting them to work, setting up the culture, some sort of general managerial aspects to it as well, all the admin stuff, right? Everything else, basically. So like a true COO type of role. So that's what I became. And again, these things happen more organically, right? So you don't really put labels to these things at the time. So I can look back and see it more clearly. But I think at that time, basically you do whatever is needed, and this is what was needed. So I sort
Right.
of took up that role, and kept building it. I think what happened was in 2001, we completely sort of, fell flat in the sense what happened was that, we built all these products. We thought, that we build great products and customers will come, but nobody came, and by the way, I see entrepreneurs making the same mistakes until today. I think the tendency of the Indian entrepreneur when the product is not selling is to build more. I've seen it consistently. We go back to building wherever sort of things are not working because we feel we can control that, right? We can sort of build more product and they'll come. Whereas the real problem in most of the cases that we're just not selling, or we have not thought of our GTM strategy, the kind of stuff that you mentioned, how we sell, where we sell, because that is so uncomfortable, right? To figure that bit out, right? Versus building is very comforting, especially if you're an engineer, you just go back to building. So I think so that's what we did, and 2001 was a terrible year for us. I think by summer we were already kind of running out of money. We didn't know sort of what to do. So at that time, actually, the good thing that we did was that we hired a new CEO. So and this was also facilitated through our VCs. I mean, they never forced us, but what happens is that VCs get resumes from a lot of people who want to join companies. So Peter Harrison, came in through Draper Atlantic. He was looking to move to the East Coast. So we interviewed him. He liked us. We liked him. So he joined us as a CEO right after 9/11 at our absolute low point. We had barely like 3 months of capital left. We had like
Wow.
no revenue, and things like that. And after he joined, our VCs gave us a small bridge, Draper Atlantic for like some time to survive. And then we kind of started rethinking the business, of what we're going to do. So we dramatically changed after that, after he joined. And he was already 15 years in the industry. He had been a sales head of a public company before, Versata. So he was basically a GTM person,
GTM in
and
the
he
tech space.
in the tech space.
Okay.
So he had done that for 15 years already. Taken companies to tens of millions in revenue. So he understood the nuts and bolts of this, which honestly none of us really did. So I think so after he came in, I would say we kind of rebooted the company and we started two things. So one is like you mentioned that we had to pick a vertical. So he pivoted our core product towards kind of mobile field force automation. So he said that okay, mobile is taking over. So this was 2001. So again, we realized we were way early,
Wow.
but mobile was beginning. People were talking about it, right? We had that Palm Pilot. He used to carry a Palm Pilot. We had Blackberries, and we thought that
Okay.
basically, everything is going to go on Palm Pilot and Blackberry. So we started, building around that and integrating how you get data there and how you get data back, for field force automation. So we basically pivoted our product what we call X Integrate to something called Synapse, which was just this, mobile field force automation. And then also because we didn't have much money to keep the lights on, we parallelly started a services business. So we thought that, we are like, we have a good engineering team. And I think that the way decision it happened was that because we had to cut costs, we had to let go of a lot of engineers in India. Most of our engineers were in India. So I think that was kind of the first time I was doing layoffs. And actually, just we thought that instead of laying them off, we found some customer in the US, our friends, who were running another company. So we said, can we offer them to them, and they can sort of pay for their salaries and, we can make a little margin. So actually, really driven out of necessity, we started this, right? And sort of so became a services. So we had a small services arm and we had a small Synapse arm, which was field service automation. And just to complete the story, while the field service automation did okay over the next couple of years, it never took off, mainly because the mobile, we were too early. The phones were just not powerful enough. The bandwidth was not there. We were at least 10 years early in that whole sort of movement. So I think that never really took off. And the services business kept on taking off. So basically over years, as 2002, 2003 came, 2004 came, we basically became a full-fledged services company. And because we'd come from this product side, so we basically, our customers became product companies. So we started selling to all other companies like us, which were, building IP, building software, and wanted engineering teams in India, to support their product development and all that. So that's what basically the business became. We renamed it first to Indus Logic, and then later on, when we acquired companies in other geographies, we renamed it to Global Logic. So that basically was the story of EB Provider to Indus Logic to Global Logic. Yeah.
Did you need to raise funds again, or once the services business got started, it was like the
We
margin was
didn't. I
good enough
think
to not?
the margin was good enough, and I think we ran it very conservatively through 2002, 2003. So we were able to build the revenue on the services side to support everything else through those years. We actually the business grew and grew. I think by 2006 we were more than 10 million in revenue. I think closer to 20 actually. So it grew very rapidly. Our team in India, because I was the CEO, I was like the team grew to close to 600 people by 2005. So I was constantly basically hiring. So my CEO role became very real. I was constantly hiring, firing, engineering, managing customers, and things like that. Arun moved to the US as well, so I was only one in India. By that time, we set up a big office in Noida. So it became basically it grew and grew. We raised more money in 2006, mainly with a view to M&A, doing M&A basically. So we thought that sort of we should grow the business through acquisitions, and that's why we raised money. But we didn't raise any money in 2006. This money, by the way, was invested in us by Westbridge, India. So I think Westbridge at that time was kind of established PE firm in India. Within a couple of weeks of investing in us, they got acquired by Sequoia US and became Sequoia India. So basically the news never really came out that we were invested in by Westbridge. It came out as Sequoia, and then Sequoia became an investor. And later on, they invested in Pine Labs, and and I have a long tradition in Sequoia because of that. But basically, that's how it happened.
Okay, fascinating. There are 2-3 questions I want to ask here before we wrap up this thread. Let me ask you this first. What did you learn about scaling a services business? Because essentially, scaling a services business means scaling people, right? I mean, that's your true asset at the end of the day. So, what did you learn about that?
So I will, before I answer the question, I'll also just quickly say what I learned about the software business, through our failures of X Integrate and Synapse and things like that. I think you already articulated them, but just to summarize, I think that GTM motion is extremely important. Like for example, X Integrate, we needed to verticalize, understand whether it's an ecosystem play or a licensing play, right? And build accordingly. The second thing I learned was timing is extremely important. So like we were early to market. And my learning over years has been that more things are early to market versus being late to market. So you're much more wrong in estimating, like, for example, if I look at AI today and things like that, People are often wrong in estimating how long it will take. They think it'll happen much quicker. It takes much longer. Especially enterprise adoption and things like that. So I think that was a learning on the software side. On the services side, people think it's a people business, and definitely it's a people business. Hiring is challenging, but really the constraint to growth is sales in services as well, because it's also a very
Okay.
commoditized business. I mean, the PMF is quite clear, right? You're providing a cheaper engineer in India, right? So I mean, there is nothing more to the PMF, right? But it's a competitive market. There are a lot of companies. Positioning is important. Sales is important. So when I see companies, let's say in Delhi, in Noida, you will see companies. Let's say if you go to even Bangalore or Noida, right, Kormangla, if you go to, you knock on any door, there's likely a services business behind it, right? There's like lots of services business in all shapes and sizes, right? From like 100K in revenue to 100 million in revenue. You'll find the whole spectrum of companies, right, in Noida or Kormangla and Gurgaon and all these, right? And what differentiates them is basically their ability to sell. All of them, I believe, can hire people. They can put in the right engineers in place. We have a lot of engineering workforce in India, but they fail to sell. Many of these start like this, right? That somebody in the US, they gave you one contract, you started like
Yes.
that. But many of them don't outgrow that. They stay there, or they add one more over years. So they never have the sales aggression to be able to add it. I think we had it. I think mainly because of Peter and sort of how he came in and all that, right? So I think so we sold big time. So we grew both organically and inorganically later on. And selling again has multiple components. You have to position, like for example, we positioned ourselves as later on the space came to be known as OPD space, outsourced product development space within the
Okay.
outsourcing space. So if you look at Infosys, TCS, Wipro, they were already very big at that time, right? And but they were mainly selling to like the CIO's organization. Like they would go to a JP Morgan and say, sell to a CIO, right? We were selling to CTOs in technology companies. So our customers over time were Google, Microsoft, all these large product companies, startups, right, who wanted to build their products. And the product development is slightly different beast versus, let's say, the CIO's department, which is more, software bug feature maintenance, things like that, right? So that became our positioning, and we stuck to that and we sold behind that actively. And I think that was a big secret to our success. Our whole packaging of our services and our ability to sell that, incessantly over years. So that was my big learn.
Amazing. Amazing. So what you're saying is that
Just to, by the way,
sales
fast
solves
forward that,
most. Yeah. Yeah.
most issues. And to fast forward that, like today, by the way, the narrative in the VC world is that there's a new generation of AI-led services coming in and potentially will come in the next 5 or 10 years.
Yes. Service as a software.
And
Yeah.
services as software. And I think, and I can see why that is interesting, and why I do believe it will happen, if people sort of position it rightly. But I think they'll have to further, because there is a positioning opportunity here. There is an opportunity to sort of prioritize a set of services, sell it against the incumbents, which will find it very hard to take this positioning because they'll have to cannibalize their own business, to do this. So there is a window of opportunity just taking the same cue within the services space today, to do that kind of thing.
Mm. But again, sales is what will differentiate the winners from. It's not technology, but it's sales, which is going to
It's definitely not
differentiate who
technology.
will win.
It's definitely because technology is very much a commodity in this case. You basically comes down to engineers. People can hire them. It's like it's not rocket science. So it really does come down to go to market, which is a combination of positioning and sales.
Mm, Fascinating, fascinating. That's an amazing insight. Uh, but at the same time, you must have created some sort of playbooks or templates for OPD.
We did over a period of time, as we again, because we came up bottom up, right? So I think as we realized that this is the market that we're in, we created more and more. So again, right from, how to sell, what is the pitch, right? To how you deliver, even sort of like, for example, we were early adopters of Agile. So again, this was the time where in India, CMM and all that sort of project management ruled, right? From Infosys, TCS, they were CMM level 5 compliant, and PMI, project management certification ruled, and things like that, right? So we adopted basically the product development methodologies, which was Agile was coming up, right? We built a whole internal platform around Agile, we called it Velocity, and essentially built on top of that. So I think that actually our org looked very different from, let's say, if you went to like an Infosys and Wipro. So it was differentiated in every which way, right? From like the way we sold to the way we delivered. And so we did that. And by the way, other players emerged in this space. Persistent, based out of Pune, was like a big company in this space. As Gartner later on defined that. EPAM, based out of Eastern Europe, came up. So this became a real space. OPD, Warriors, and players sort of put themselves in this space.
Okay. Okay. The other question I wanted to ask you on this thread is about M&A. What's the I mean, when is it a good time to do M&A? What should be the rationale behind doing M&A? How should you identify that this is a good M&A to do or not?
So the backstory, I'll just tell you a little bit about our M&A story, and then I'll maybe answer it a little bit more generically. So in 2005, 2006, we found ourselves in a unique position where we were a services company which is backed by VCs, right? Which is not the norm at that time, right?
Yes.
And because you were backed by VCs, and also because of our own DNA, we were growth centric, right? We wanted to get to a certain number. We want to achieve 100 million. I remember our internal goal was to achieve 100 million by 2008 and things like that, right? In revenue. So I think, so and we thought that organically we can only do so much. We should look at sort of acquisitions and things like that. And it can be, and again, sort of our board had seen that happen in other companies, our sort of Peter had seen that in other companies, and we were all kind of good learners. So I think, so we felt M&A is an interesting strategy for us to augment our growth. We also wanted to expand regionally. Like we were mainly basically Delhi, US, Delhi, DC at that point of time. So we're looking sort of how we can get to other regions, both from delivery capability perspective and a customer perspective. So actually, that's where our company GlobalLogic moved me into head of M&A role in 2006. So I replaced myself. I hired Prokul. He came from HCL, 25 years at HCL, and joined us as CEO. And I moved into M&A role because I think for no other reason that sort of everybody felt it's an important enough thing that one of the founders should be involved. And I guess, they looked at me, and for whatever reason, I took up that role. So literally from a Friday when I had like a 600 people team, I went on a Monday where I was like literally alone. And my goal was to buy companies, after I had it over. So it was a dramatic change for me again, that change in role in 2006. So for us, our learnings in M&A were that we ultimately again sort of went back to acquiring high quality customers. So we tried a few things. We acquired 6, 7 companies during my time. 2 or 3 companies a year, and we felt the most value for us was where we acquired high quality customers, because again, getting into high quality customer relationships is very challenging from a GTM perspective. And it has become more and more challenging over years because already there's a queue of companies, right? And there's no dearth of vendors who are getting into them. So to give you an example, we acquired a company in 2006 which had one large customer in the telecom space, and at that time, they were doing 6 million a year from that customer. And today, GlobalLogic is doing 100 million a year from that same customer, 14 years later. So I think as you get into these large customers, you can really sort of cultivate them over years and keep growing for many, many years. And that's been the key for large successes for the services companies. So for us, for service companies, our strategy basically became acquiring high quality customers and over a period of time, delivery capabilities. Like we set up a big Ukraine operation. So I acquired first 3 companies in Ukraine from 2006 to 2008. We had 2,000 people in Ukraine in those years, which is like really large for Ukraine. We were the largest software company in Ukraine, in 2000s. I tried to acquire a small one in China. It didn't really work out for us. We tried to acquire in Latin America. So our thing was, and that's where we came Global Logic. So our idea was to set up these capability centers across the world, and sort of have customers around the world as well. So that was our M&A
Why,
story. Yeah.
hmm, hmm. Why
Yeah.
couldn't you service from India only? Why did you need to build capability
We
centers outside India?
So we thought that the positioning itself will help us in different ways. We felt we could service Western Europe much better from Eastern Europe. We felt, Latin America would give us same time zone capabilities. Some of it was just, I think, as entrepreneurs, you just start drinking your own Kool-Aid at some point of time, right? So this thought somehow happened to us, I think, in 2005, 2006. And I think, it stuck in our heads and we thought this is a good idea. I'm sure you can equally build it from India. Like thinking back, I don't think there's no reason why you can't do it just from India. Uh, you know, but we thought this is a differentiator. I think how it happened was we were pitching to a customer. He asked us that, do you have capabilities outside of India? Do you have capabilities in Europe? Do you have capabilities here? And I think that planted the seed. And then we thought, okay, it's helping in sales, and then we just made it a strategy. So these things start bottom up, I think, usually, and then some companies wrongly or rightly make them a strategy. So that's what happened to us.
Okay, fascinating.
So that
Uh,
was our M&A. I would say for us, M&A worked really well. When we sold, so Global Logic sold to Apex Private Equity in 2013. It was 100% acquisition by Apex. At that time, we had about 240 million in revenue, from what I remember, and I would say about 100 million of that was acquired. So it was a significant addition to our own, let's say, repertoire and our capabilities and things like that. So I would say, looking back, it was extremely valuable and creative for us as a company, and it was, so and that's why I personally became a big believer in M&A. So after that, things that I have done, in our startups and in our sort of, uh, you know, at Leo Capital or prior to my angel investments, I'm always championing M&A wherever there are opportunities and possibilities, because I've seen it provide sort of multifold results to companies, and I've done it myself as well. But having said that, I've also realized it's not easy to do. So you get it wrong more often than you get it right. I think entrepreneurs need a certain level of courage and sort of conviction to be able to do it in the right manner. But when it works very well. So I think so that's been my learning.
so you didn't stick around till the private equity acquisition of Global Logic. What did you like? What made you want to move on? What did you do next?
So, by the time 2008, 2009 happened, our company had become substantive, right? I mean, we were over 100 million in revenue at that time. It was a large operation, 4,000, 5,000. I'd been running M&A for 3, 4 years, so I was I'd fully moved on from operations. So I was not really, M&A was a completely separate team. I'd had two people, so we were a 3 people team, basically deal making, so I sort of separated myself from the operation. So I think there was an opportunity in 2008, 2009, and I think the company was actually undergoing an acquisition discussion at that time. So I was thinking, I think all of us thought that will happen in the next 1 or 2 years. Eventually it took much longer, and it happened only in 2013 with Apex, right? At that time, it was a different buyer in 2009, 2010. So I thought there's an opportunity for me to sort of do something else. I had my equity in the company; it was fully vested, right? So I thought that this is kind of the right time for me to move on. The company doesn't need me in that sense. Like it's well formed, the leadership team is fully set. And I'm not really a part of the core operations. So, and also what I realized was that stuff was happening in India. So again, remember, I was the only one based in India. Everybody else was in the US, right? All the founders,
Right.
all the leadership team. So I was kind of like an outpost, in India. So I think again, I thought either I move to the US, right, and really become a more active role in the company. There were talks of sort of a change of CEO, things like that. At that time, ultimately Shashank became the CEO, who's the current CEO of Global Logic. So there was talks, maybe one of the founders take it, maybe I take it, maybe somebody else take it. And I just didn't, it didn't excite me. At the time, I felt that this is like India has a lot happening. Flipkart had gotten funded. Flipkart had just raised 1 million
Mm.
from
Okay.
Tiger Excel in 2008, 2009, somewhere around that time. So I felt India is very exciting. I'm in India, and I felt I'm missing out. I'm doing this global business, but India, there's so much happening. I should do something in India. So I think that's what led to my coming out. So it was extremely amicable. I sort of almost, it took an year. I came out towards, I think, end of 2008, early 2009. Also, Pine Labs exit happened around the same time,
Right.
so I had some liquidity as well. So that kind of reduced pressure. I could see, have money for a few years. So I came out and with a view to doing something in India, basically. That was the whole thinking, go more domestic. It's ironical because, I started domestic Mind Labs, then went to Global Logic, and then came back to domestic. So that's what happened. And then after I left Global Logic, I started working for Sequoia in India, just because they were investors in both Global Logic and Pine Labs. So I had a great relationship with them. And they were also early in India, right? This is 2009, so they were 3 years old. By the way, after Sequoia US acquired Westbridge India, they had a fallout. So in 2008.
Okay.
So then Westbridge
Okay.
became Westbridge again, and now it's Westbridge operating as Westbridge. And Sequoia India came completely under Sequoia US, and all the people got promoted. So like Shalinder, who's kind of Shalinder, and all these people who are now the main managing partners. But prior to that, they were kind of mid-level VPs and all that. So they all got promoted to partners basically overnight. After that fallout, and the entire team took
Wow.
over GV, Shalinder, and all that. So I think, and they did a great job, obviously, running Sequoia India. So I think, so I joined Sequoia as what they call like an EIR, entrepreneur in residence. The idea was to, honestly, more than anything else, just to hang out, see what's happening in India because they were investing in India, and see what I want to do. So the options were either maybe join Sequoia, after a year, maybe join one of the portfolio companies, maybe do nothing. So it's like a loosey-goosey position usually, which is I think like a hanging out time, for a bit. So I did that, and by the way, there I was deputed with Travel Guru, which was one of their online travels. At that time, there were three travel companies in India which were leading, which was Make My Trip, Clear Trip, and Travel Guru. They were all funded, and ultimately, Make My Trip won that battle. And Yatra was the fourth one. So Make My Trip became number one. Yatra acquired Travel Guru, and Clear Trip.
Okay.
I don't know what happened. I think it still exists, but I think Make My Trip raced away from everyone else in terms of market share,
I think
things like that.
Flipkart acquired ClearTrip, if I'm not mistaken,
Yeah, perhaps.
or something like that.
So
Yeah.
yeah, something like that. So I think so Sequoia was into Travel Guru, and I sort of consulted with them for a little bit, but then they got sold. Then what happened was that while I was in Bombay, so I was at that time Sequoia Bombay office was the main office. So I used to sort of go to Mumbai a lot and hang out with all that. I bumped into Avishkar, which was like a impact fund run by Vineet Rai at one of the
Yes.
events, and I really got seduced by the whole impact story. I thought, this is really great. This is what I want to do. I can fix India's problems. So I really sort of again overestimated my own ability of what I could do. So I joined Avishkar then. I left Sequoia and joined Avishkar again as a consulting in Bombay for a little bit. Had great fun. Spent time in sort of rural areas, mainly of Gujarat and Andhra Pradesh. So I'd never really experienced India, right? So because I come from India, I come from UP, right? But it's very different when you're working, truly, in India. And Global Logic was all global. Pine Labs was mostly
Yeah.
Bombay. So I first time truly I saw India in a very different way, right? Tier two India, tier three India, villages of India. So I had a blast, I would say, of doing that. But I also realized that Avishkar was going to be a long journey. And I think impact is India is extremely complex. I was still young, right? I was like 32 at the time, so it felt like a life commitment at that time. Versus like nothing would happen quickly here. Like I thought, if I have to do this, I have to commit 20 years here, to do anything, and I just wasn't ready for that. So I came out of Avishkar, and then within Avishkar, I was kind of investing in education businesses. One of the sectors that because they were impacts, so they're looking at education, healthcare, water, hygiene, all these kind of areas. So I got exposed to education. So I had sort of this thought of doing something in education. I thought, that's both impact and possibly a commercial opportunity. So that's how I came out and started thinking of education, and then ultimately started, you know, a company which was called something else, EduCircle, eventually which became Sunstone. in the avatar that it is.
What was the original avatar? The version zero of
So
it.
yeah, so the version zero of it was so again on the team, by the way. So I had this guy DK Dinesh Singh, who used to work at Pine Labs in the first year. He was like our first GTM guy. So he was great friends with me, and so he worked with us for a few years. Then he went to the US. He did his MBA at Cornell. Then he worked for McKinsey in the US. So just on that time, this is 2009, 2010, he was coming back to India, and he approached me, and we started chatting that should we do something together, and he wanted to do something in education as well. So him and I started, so we became co-founders, and we started thinking, okay, what can we do in education? So, and this is really a fascinating story because I've seen this pitch so many times after that. Almost every sort of educated person in India who thinks of starting in education, and you'd be surprised how many there are, they think of like a finishing course in the fourth year of like undergraduate. So they think that, the colleges are not doing that great a job, so what we can do is in the fourth year, we can train students, for a 6 month, 3 months, right? And put them into jobs, basically sort of like a finishing program, whether it's technology and
Right.
things like that. And I've heard this at least 20 times, this pitch for the last 10, 15 years, and I, especially
Sure.
from people who return from the US, who are not as exposed to India, as people are. So I think, and that's what we did. So that was the first version zero of EduCircle because it just made logical sense to us, that there's so many students and we can do something through technology. So we did that. That was the first version, 2, 3 years. We did that. Again,
This was an
based
on-campus program, like you would sign up with a
hmm.
college and run it on campus, or like a B2C?
So our goal was to do it more online. So our first pilot was on campus. So we basically
Okay.
went to campuses here in the Delhi region and Noida. There are a lot of campuses, and talked to those deans and said, okay, can we run something, place your students and things like that. So the first version idea was to tie with the campus, but run it as much as online as possible. What we realized was running it online was extremely difficult because I think the labs at the campuses were just not equipped. Internet didn't work. Mobile internet hadn't really come at that time. So there was just no motivation. So it became more offline plugin. In the end, we ended up sort of going there, taking lectures, and then hiring people over a period of time, to do that. Also, we realized that the relationships with campuses were extremely strained. They had very different motivations, and if we did too much, they became insecure. If we did too little, they didn't want us. It was a very difficult balance to strike
Yeah.
with these
Was the
campuses.
college paying or the students paying? Who was the payer?
So, in the first version, we just did it free. We thought, let's prove it out. Then the idea
Okay.
was that actually the college would pay, which they were challenged. Then we tried the student would pay, which was also challenging because the students' parents
Yeah.
would say, hey, we've already paid for a 4 year program. What is this 3 month magic wand now that we have to pay on top of that? And then, that you'll get a job. And then the college would say, how, we look really bad that, we charged 3 lakh for a fees. And now you're charging 20,000 on top of that. How do we explain it? To parents that why does a student need this 20,000 to get a job versus what we did, right, for 3 years. So it's this complicated dynamic between sort of campus, student, parent, and us. So it never really worked. So then I think we became B2C. We completely gave up the campuses after a couple of years. Around 2011 we became completely B2C, and then we launched like a full, like a 1 year online MBA program. Basically we called it PGP, which was on the lines of, let's say, like I'm Lucknow distance program, or some of these programs, but again completely online with sort of some interventions physically. So we ran that, so from 2011 in 2014, 3, 4 years we ran that, and it did okay. We got up to 4 or 5 crore in revenue. We had, like, I would say 200 students a year, something like that. But again, we
And this was
realized it
like
was
full-time courses, like people would
part
do
time, no,
this.
part time. It was
Okay.
for
Okay.
working professionals. So somebody who's like a techie, global logic
Yeah.
engineers for 5, 6 years of experience, want to move into more product management or commercial type of roles.
Yeah.
So
Like
this
a
was
great
meant for
learning or
first,
upgrad.
basically great learning one. So Mohan was a very good friend of mine. So we saw him, doing something similar in a different way. Then I think there was another one in Bangalore, who was doing that. So there were 3, 4 companies. Northwest was doing like a West sort of campus-oriented program, more expensive. ISB was doing ISB Max, which is a 25 lakh rupee program. So there are many people coming at it from different angles. Ours was like a 2-3
Yes.
lakh, cheaper program, tried to sort of, make incremental changes. Um, so, I would say the product was successful. I think the students liked it, but we also felt that it was really challenging to scale, because I think, again, there was a constant burden of B2C selling outcomes while they were there, but at scale, it was hard to envision how these outcomes are going to be. More than anything else, sales was just a huge burden. It's very consultative sales, talk to every student, and sort of knock them down. That sort of network effect didn't seem to be sort of kicking in, at least for 3-4 years. Maybe if we had stuck longer, and Great Learning did well in the end. But I think we started feeling more and more burdened by it in 3-4 years. And then actually, ironically, in 2014-15, we went back to campuses. We felt that we said that one mistake that we did in our first version was that we were providing an incremental capsule. So instead of doing that, why don't we run the whole program? So the new sort of version became that we will go to an MBA campus. We will do admissions, we will do the entire teaching, and we will do the placement. And all that campus needs to do is to just provide the infrastructure and the license, basically, because they have the license and they have the infrastructure. So this started working well in 2014-15. So we took over one full campus, right, where sort of we basically were responsible for everything, and the campus owner was only responsible for the license and the infrastructure, right? And that started working well. So around 2015-16, the company pivoted back to campus, and we actually abandoned our online program completely. uh, you know, and actually now, if you 8 years later, that is the one that is working very well. So that is what Sunstone does today, and I think that model kind of worked. I would say, after that, what happened was that 15-16 happened, and I think I started thinking that this is too much ops, too little tech. I think DK moved on. He had to do some. He joined another startup. In the travel space, he went back to the US. So I think all that happened, and then my personal life changed. My wife decided to start a PhD in the US, so we started thinking of going to the US and all that, right? So all this happened, and then I felt that I should sort of put a different team in place. So around 2017-18, the current team that runs Sunstone, Ashish and Piyush, they came to me and they said, Rajul, we're looking to do something in education, give us some advice. So I basically sold them Sunstone. I said, look, this is really working well. Why don't you sort of take this over? And we'll sort of recap it, make sure it's attractive to you as founders, and we'll become shareholders in it. So that's how basically the Sunstone story happened. So Ashish and Piyush took it over, I think in 2017, 2018, around that time. They have been running it ever since. Now this is for the last 6-7 years. So I'm a shareholder, Dinesh is a shareholder, and then eventually they raised capital from Prime, Sama, and Westbridge. So it's all comes back to Westbridge after 2006. So I think so that's been the Sunstone story. So at this point of time, I continue to be a passive shareholder in the company. But the company is practically run completely by Ashish and Piyush with Westbridge's support.
Okay.
So that's the
Okay.
Sunstone story.
So you shared a couple of learnings on B2B SaaS and software, and for example, you need to go to US. Building B2B SaaS in India will not work unless you are monetizing through transactions or something like that. So what's your learning on the edtech space? Like, what will work in India, what will not work in India? Whom do you see as successful edtech companies in India?
Yeah. So look, I think there are tremendous learnings. One, because this was a very India B2C business, right? Pine Labs was again very different B2B, right? We were sort of isolated towards BPCH, Lumberjay, and all that. This is like you're out in the market, right? Your elements, you're directly exposed to the elements, right, of
Yes.
Bharat, right, and everything. So this was very, I would say this was truly formative. It's ironic because honestly, when I started Sunstone, I thought I know now everything, right? I've been two-time entrepreneur, I will kill it and all that. But it was very humbling because this was a very different business, and sort of they were completely new learnings, for me. I think some that have stayed is that again, business model is really, really important, of how like we tried different things, right? Small capsule, big capsule, B2C. So when you're again, all these are ecosystem plays to some extent, right? When especially in edtech, and it's a regulated industry, government is important, right? So basically making sure that you have the right piece in the ecosystem that you can run is again extremely important in edtech particularly. Within B2C, I think one big learning I think Dinesh and I talk about all the time is you know think of like our model in the second version of Sunstone where we were doing selling this 1 year MBA program, right? There is a
The great
constant
learning model.
sales burden every year. Like let's say we did 1 crore of revenue this year. Next year we have to start from zero. We have to get fresh students, right, to give us, let's say, 1.5 crore or 2 crore revenue. So we have to do twice the sales next year, to beat this year. Then the third year we have to do 4 times the sales that we do this year, and all from zero. There is no sort of carry forward, right? It's like there is no recurring customer because the students would graduate, right? And then you have to sell afresh, and that is true for nearly all edtech companies out there. Think of Baiju's again, right? So they're selling afresh these programs, right? Because the last year sales finishes, right? You go to An Academy or you go to any of these large businesses, right? We later on invest in Edureka. So sales business, edtech businesses, ironically, are extremely sales heavy, and that's why you see like why is Baiju employing Shah Rukh Khan, right, to sell on TV?
Yeah.
It does not stand to logic. And then we analyze that lovely professional university in those years in 2013 14 was the largest advertiser on TV. They spent like 1,000 crore on TV ads in 2013
Wow.
14, right? So I think so our learning, which again we didn't realize, was that edtech is a completely marketing and sales business. Again, and I thought I was getting away from that, in some sense, but this is even more of that because you're selling thin air,
Yeah.
essentially
Right.
you're selling thin air up front, right? And I think all the tech companies suffer from this. And also you will see, hence, there's a lot of mis-selling, there's a lot of internet sort of brickbats, right? Of कि मुझे ये बोल दिया, this was told to me, this didn't happen, things like that, right? And this is all part of the same package that, it's like you're trying to convince a student and sell them a dream, which can be very easily misinterpreted, in real life. And I think so that's a big edtech story. Why we like campus is that it's an imminent market. We know that there are 1 crore undergraduates, people who graduate from class 12, and they have to do some sort of undergraduation. Some of them do MBA, right? Things like that. So I think a pipeline which is already set, and all you need to do is that you get into that, you do a better job, you raise your hand, you say, okay, we are like a better version of a product that you already understand, versus like it's a completely new product, which I have to sell you the dream, I have to make you understand, and I have to do much more of that every subsequent year. So I think
Mm.
the big learning consumer business for us was the value of LTV, right? The lifetime. Again, it's kind of obvious,
Right.
but again, I see sort of customers, companies making this mistake of like however much you charge, right? Sometimes people think of payback, say, okay, our CAC, they say our customer acquisition cost is 10 rupees. I make 20 rupees, so it's great business. But the point is, if you make that 20 rupees in 3 months, but then you have to sell afresh, right? Then growth is really challenging. Yeah, every year you have to
Right.
sell more and more and more and more. To build a 100 crore business, you have to sell immensely, right? So I think that's the one learning I would say for consumer companies, and that's why businesses like Flipkart, Meesho, Amazon are so sort of awesome, or Zomato, because the lifetime value is just immense. Once you're on these platforms, you just keep buying and buying and buying and buying, even if it's small ticket, and even if they have to spend a large amount of money to get them on the platform, but the lifetime value is immense. Versus some of these edtech businesses, you have to spend a lot. It can get paid back, but the next year you have to spend even more, to get a fresh set of customers. So I think that was the big learning, if I can, for consumer business.
Okay. Uh, the the word of mouth and brand reputation is pretty strong in education sector, right? Like
It's
people
a
clamor
complete
to get into it.
misnomer. It's a
I
complete fallacy. It's a complete
Okay.
fallacy in my experience, Akshay. It takes years and years to build that. People learn. There is no word of mouth brand recognition for many, many years. Like the large institutes have it today after like 20, 30, 40 years, also because they're government, so they're not selling actively. The moment you sell actively, all that brand recognition goes out of the window very, very quickly. In fact, there is a negative connotation to scale. People students often think, अब इतने सारे बच्चों को कैसे पढ़ाएंगे, right? How will they place them, right? It was okay when they were small. Or you often hear, even like when I talk to my IIT seniors, right? They say, IIT is now sold out. Now we're taking everyone, right? There are tens of thousands of people coming in. So they actually feel bad about it, versus feeling good about it. So
Right.
actually it's a complete fallacy. I think the brand building is really difficult, and the word of mouth takes decades to kick in, in any meaningful way. And that also, if you're doing it the right way continuously. So in Indian edtech landscape, I see zero companies today where, let's say, the word of mouth is driving growth. It's completely sales and marketing driven for all the companies that are out there today in the Indian landscape.
Fascinating. What's your take on the test prep sector, like
Test prep is
offline,
a
online,
little bit
both?
test prep is a little bit easier in the sense that, again, since an imminent market, again, sort of, let's say you take IIT test prep, then there are, million kids studying for it. And only whatever 10, 20,000 get in as of today, but you can charge the whole million. So I don't like the characteristics of it, just because it's so sort of, I mean, I'm not a socialist, right? But it is just somehow doesn't something feels wrong to me in this picture, that you're charging 100,000 kids, a million kids, and only 10, 20,000 are getting somewhere. But the market is imminent. And again, sort of, if you see, the test prep market has been propelled. And you go back to IT and IIMs. It's not ITs and IIMs who have sold themselves. It's the test prep companies who have sold them. They've been
Yeah,
advertising now for
so
30
true.
years, right? Right from the first generation of companies to today, of like how great these
Right.
institutes are. So that pool of people, who are investing in that has just swelled and swelled and swelled. So I so as a sort of as a just as a social model, I don't love it, but as a capitalistic model, it has worked because we are a large population. It's aspiring to get into the same places, and it does provide for make for good business in that sense. It's easier than actually learning, training, degree program or things like that, because the outputs are fuzzy there. Here, the output is very sort of binary, right? You get in or you don't, and you don't really blame, the test prep company one way or the other.
Mm, mm, mm. Okay, okay, fascinating. Uh, I know Sunstone has flirted with this income share as a business model. What's your take on that? That you monetize once student gets placed, right?
Yeah,
Yeah.
so we started with income share in 2015-16. That was our first model, because again, we wanted to align our incentives. We thought that, again, the whole thought was to dramatically change the education system, right? How can we make it more accountable? How do we give more value to students and things like that, and share in that value, right? So that was our first model, and that stayed for many years. I think over years now, as the company has gotten bigger, the school has become bigger. It's also harder to enforce income share. Attribution is not easy. That did my job get placed through the institute? Some people get placed outside. So it's harder to collect after 2 years, right, of like chasing students and getting that money, even if the attribution is clear. So I know that actually the company has moved away from income share model. So it's less income share today, more what they call placement guarantee of money back type of things, things like that. So I think, but I think it very much started with that. I think is still part of the offering at Sunstone, but I think now it's been replaced much more by money back guarantees and things like that.
Okay, okay. So you're saying income share is not a good business model because it's a leaky bucket. Like there's a lot of
I do
revenue
think
leakage.
in I do think in a country like India, you want to avoid conflict versus creating conflict. It does open up to, let's say, litigation, right? A student can always, even let's say if you're on the right? Let's say the company is right and the student is wrong. But if a student complains, chances are that everybody will favor the student because, he or she is a student. So it does open up to conflict. And at scale, it is very challenging to run because of that. It's very easy for like a student to bitch about a company and say, hey, they took my money, they didn't even place me, this and that. And nobody has the patience to understand what has actually happened or detail what the truth is, right? I think the student's version will be considered as truth. And inevitably at scale, more and more of these things will happen. So I think especially in education, you want to minimize conflict, right? Make it as streamlined as possible if you want to achieve some numbers. Otherwise you'll just get bombarded by these things.
Mm, mm, mm. What do you think was the secret behind Great Learning's success? Was it that they went global?
Yeah, no, yes, I think so. Great Learning has also evolved over the years, right? Again, I know the company closely because, Mohan has been a very good friend of mine for many years. So I think, yes, I do think part of their success was bringing in these global university programs to India. And part of the success was also sort of their acquisition or sort of the partnership with the school in Chennai. So that became
Great
a part of their
Lakes.
fold. So they were able to Great Lakes, so they were able to sort of partner with it in a much more meaningful way. But it's not been easy. Look, I mean, Mohan started in 2006, so again, this is now an 18-year-old business, and again, sort of obviously they got acquired by Baiju's 2 3 years back in a peak market, so good for them. But again, they also got Baiju equity as a part of that acquisition, and I
Oh,
know
okay.
it's probably not very valuable as of today, so I think
True.
it's been challenging, but but they still on the whole did a fantastic job. Part of, I think, the team, Mohan is just again a fantastic entrepreneur and all that, kept persisting and then did all the things right that they needed to do to make it work.
Okay. Okay. So let's talk about Leo Capital now. Um, do you see yourself now as somebody who is enabling startups and supporting startups, or do you see yourself running a financial services business? Because in a way, a VC firm is also like a financial services business in private wealth management kind of a space. So what do you see yourself doing?
So I think, and maybe before I answer the question, I'll just give a little bit of the origin story. So after I came out of Sequoia, I started angel investing of my own, right? So I started around 2011, 2012, and then picked up pace more in 14, 15, after I became freer from Sunstone.
What kind
So I
of
think
companies did you invest in?
So I invested in all sorts. I think I was in Delhi. The market was underserved. I started this breakfast meeting in Delhi every Sunday, and it was very well attended. A lot of people showed up for it and threw up a lot of opportunities. I think the bigger successes that came out of my angel portfolio, the biggest is Misho. So I was the first check in Misho. It started sort of in 2014, and literally I promised them when the Misho book gets published, I will give them the physical term sheet that got signed of the angel round because I only have it. So I
Okay.
think so that was Misho, and then I did 1MG, which got later on sold. So a lot of internet because internet was kind of coming on. I ended up doing a lot of health. Again, remember, I think from my Avishkar days, I'd gotten exposed to education and health. So these two sectors I was particularly looking at. And since education, I started my own business, I got interested in health a lot more. So I did a company called Quickwell, which was bought by Practo. Good exit
Correct.
for everyone, cash exit. It's still a big part of Practo today, like is the whole hospital appointment booking system. Um, I did a company called my first angel investment was a hospital chain called Cygnus Hospitals,
Okay.
which what it does was it was doing the same thing actually that Sunstone was doing with campuses. It was doing with hospitals. So it was taking over hospitals and aggregating them and running them. Eventually, it got bought out by Ujala Group, the Amar Ujala guys, a few years back.
Okay.
And then just last year or earlier this year, it raised a large round from General Atlantic. It was in the news. So I think I've exited it fully. So I just did a lot of healthcare and did a lot of internet. I think if I had to pick, these two. And I think while I was investing, I think that's where I realized one, I started enjoying the process of investing because earlier when I was at Sequoia, I didn't really do enough of it and sort of I never really got in the thick of it. B, I also felt the gap in India. A lot of these entrepreneurs would come to me because of my past entrepreneurial background. They would feel that sort of I had more to offer. Even companies which had sort of large VC funded funding, would sort of come to me for advice and things like that. They felt they were not getting enough. They needed more, from somebody as an operator background. So I think the thought of behind Leo Capital, starting Leo Capital was, basically that an operator VC, because I felt that gap was kind of there in the market. So 2017, 18, I combined with Shwetank. Shwetank was an entrepreneur also in India. I did angel invested in his company in 2013, 14. So we've gotten to know each other. So we started the fund in 2017, 18. And the idea was basically that of an operator VC. To your point of how do we basically help entrepreneurs succeed better? through sort of more real life learnings that we've had as entrepreneurs. And I think now over years, maybe there are a few more funds like that. I think Girish started together. There's a couple others I see, but I think still there are fewer. If you look at the larger pool of capital,
Right.
I think it's more less operator type. It's more, let's say, financial services type. So that's been our journey over the last kind of 6, 7 years, 2018 until now as Leo Capital. To answer your question, look, I think we started purely as operator. I would say, like everything else in my life, as you've seen, we've learned through the financial services aspect of it. And I today I do think all VC firms are very much financial services businesses. We have to, we are accountable to our investors. We are accountable for returns and things like that. And that is a very important sort of strand of running a VC business of any kind. But I think hopefully we can stray true to our original DNA, which is that of operator and building companies, because that's what we enjoy the most. I think when you asked me the other day, I think when people ask me why am I doing this, right? I think the big reason for me personally is to help create large companies. I feel if we can help, I've been fortunate to be parts of large successes, Fine Labs, GlobalLogic, Sunstone, Misho, in our portfolio now, Lambda Test, Beto, so I'm hoping if I can look back 10 years later at sort of a portfolio of companies which were large enough to have a global impact of some sort, I think that would give me a lot of satisfaction. So I think that's why I do it. And I think that's an important part of our DNA of our firm. But we are very much a financial services business. So we're subject to the same rules. We're subject to the same, limitations. And that's the game we're playing. So we have to play it by those rules. Yeah.
Hmm. What is the business model of a VC fund? Like typically, wealth management means you take a share of the assets under management. So,
It's
how does
exactly
it
the
work?
same. It's exactly the same. So let's say your fund is $100, then you take a management fee, which is typically 2% every year. So that pays for your expenses and things like that. And then you get a profit share, which is called a carry. So let's say you generate $200 as a return on that $100. So you take 20% of that $100 profit. So the 2 by 20 is the sort of baseline for most VC firms. Some innovate a little bit, make the fees a little bit lower, carry a little bit higher. Some basically go the other way. So I think there is like small variations on that, but predominantly it's that 2 by 20 sort of rule.
Hmm. Okay. What is your fund strategy? And where I'm coming from is, for example, someone like a Fireside has a very different strategy from a Sequoia, where Fireside wants every company it invests in to succeed, whereas a more traditional VC model is go big or go home. They are okay with 8 out of 10 companies in their portfolio not succeeding as long as there are two large outcomes. So, what is your fund strategy like?
So I come from the sort of Sequoia school, because I think that's the firm that I've seen most closely. And when I was at Sequoia, a lot of Sequoia US folks used to come down, Mike Moritz and Doug Leon and all that. So I've sort of grown up listening to the story, even our own VCs, Draper Atlantic, and then later on, we had NAV and a bunch of others, NEA, so I mean, they all follow that sort of go big, go home, or go home type of thinking. Even when you look at returns, let's say if you look at the last 50 years of venture returns, I think the best returns have generally been produced by, large wins. If you think of Sequoia US, right, 50-year-old history again, I think their entire history would come down to maybe 15, 20 companies at most. Like, I mean,
Right.
maybe
Okay.
if you take those like 15 companies out, the returns will be
Mm,
dramatically different, right? The whole firm will look dramatically different. So I think
mm,
so my sort of, and again going back to sort of the personal mission of producing large wins, I think that's what we are into. That's what how
mm,
we look at the firm. uh, Rightly or wrongly, maybe the venture ecosystem is changing. People talk about it. Maybe there you can run it different ways. And Fireside has certainly done very well in the last 5, 6 years. And again, sort of the team knows this business very well. Kanwal has been doing it much longer than I have. So I think um, so. I maybe their strategy is a legit strategy, and I think they should also do well. But at least from our perspective, we think of it sort of our strategy is more closer to the classical
mm.
venture things, which is to help produce large wins, and that's what produces most of the returns.
Okay. So how does that influence your choice of which companies to invest in? Oh.
It influences greatly because we can't really invest in stuff. Let's say something was pitched to us, which is like a short 3-4x, let's say, right?
Hmm.
We would not be able to invest in that, and entrepreneurs often get puzzled with that, right? So think of it this way. So right now, let's say our third fund that we're investing on right now is a $75 million fund. So let's say, and we normally write 1.5, 2 million, at the seed stage in a company. So let's say a company pitches to us, and we invest 1.5 million in that. And let's say 4 years later, the return is 5 million, which is, I think, a great return, right? 3x, 3.5x, right, in 5 years. But from our fund perspective, from 75 million, we have to return 250, 300 million, right, over eight-year period to generate, let's say, a 20% IRR, right, 25% IRR, 20% IRR, let's say, right? So,
Hmm.
so that 5 million doesn't really contribute to that 250, 300, and that's what we are measured on, right? So,
Right.
so while it might be very attractive as an individual investment, but as a portfolio, it doesn't make any sense to us. And this is very hard
Hmm.
for entrepreneur to understand many times, right? They say like this is like a short 3-4x. There's very low risk, and we find it hard to explain why it doesn't make sense, for us.
Hmm.
So we need wins which are ideally like 50 million or more, right? When we
Hmm.
invest, right? And I think, or at least 20, 30 million, so that if we have a few
Hmm.
of those, right, we can sort of make a dent on our overall fund portfolio, right?
Hmm.
So that's how we look at businesses. We are looking at businesses which have the potential, even if it's a lower chance, right? And it's obviously a risky investment, but who have the ability to return large returns to us. And over a period of time, we can double down on them and put more money into them. And that's basically the classical fund strategy.
Hmm. Okay. How did you go about building your thesis? I mean, one approach could have been to say, okay, I believe in these four or five opportunities and I will hunt companies which are operating here. Or the other could be, let's talk to a lot of founders and we will find the really interesting, good ideas through that.
So we are definitely more bottom up, I think, and also when you look at, but within tech. So one, we don't do anything non-tech, right? Because I think, like for example, Fireside does a lot of consumer brands and investments and things like that, right? And the other funds who do consumer brands, we don't do any of that. So we only do tech, but within that, we are very bottom up. We believe there is a seed fund because we're writing, usually 8 to 10 investments, new investments a year. So when you do that, it's hard to be sectoral and say, okay, we'll do just this, right? I think we are looking for more breadth as well. With each fund, we are writing 25 odd investments. So, we need some breadth in that. So we are more bottom up. And we look at our job basically as to find sort of solid entrepreneurs in large spaces. So I think where businesses can be built in the next 5-10 years, and then basically work with them, to help create these businesses as much as you can. So that's how we look at our lives. So I think we would sort of meet a lot of entrepreneurs in Bangalore, Delhi, other parts of the world, where we feel, these folks can build, large businesses, have the ambition, have the, jobs, have the skills, and basically partner with that. So we're more bottom up. So second category in your sort of description. But we do learn through that because we meet so many, right? So we then, over a period of time, we formulate our thesis in certain things, and we have like a portfolio of 60 companies. So we have now real experiences, right, of what worked, what didn't work, sort of what is. So that obviously also informs all our decisions, right? So I think, and that, so we are more sort of, let's say, we have more theses in certain areas where we invested versus others we haven't.
Okay. I had interviewed Rahul of Stellaris. He told me one of his mistakes as an uh, early in his career as a VC, was over indexing on the TAM. And he felt that good teams will find their own TAM. Don't worry about the TAM. What's your take on that?
This is a really tough one. We still find it hard to invest in spaces with less time. I do agree with him. That's a tough choice because there are examples of companies where entrepreneurs started somewhere else. Like, if you look at my own journey, right? We started one place in all three companies, right? Pine Labs, GlobalLogic, Sunstone. They all ended up very differently from where we started.
Yes.
So I was thinking back, if we were investing in my own companies, you would struggle because, say, the TAM is limited. Let's say if I go back to our EduCircle days and all that, right? So it's a tough one. I personally think that we still over-index on TAM as a firm, because I think we do worry a lot, and we feel that that pivoting that happens, from one TAM to the another also destroys a lot of value. And we're a small fund, so let's say if our money is not utilized, in unlocking the TAM, then we can actually lose. It can be a bridge round, it can be a down round. We should sort of invest
Okay.
in the next round versus the early round. So I would say we still over-index on TAM, which may be a mistake. And I have seen this. I think there are funds which are over indexing on just entrepreneurs. And they say, okay, this is really a plus entrepreneur, we should invest. I would say we do both. We do TAM and entrepreneur. And in our head, actually, market is first. So we struggle to invest in sort of markets where we don't see the TAM, or where sort of we worry about that too much. So I both agree with him, but we're also guilty of that, I would say.
Okay, interesting. What are the large markets? You said you formed a thesis after running this for a couple of years, so you would probably have like some clarity on these are large market opportunities in India or to build out of India
Yeah.
for teams today. What are some of those?
So in India, at the highest level, if you look at the just the GDP itself, right, then all the core sectors that are related to the GDP, right, so which is financial, fintech, right, edutech, health tech, logistics, prop tech, these are sort of large sectors in India. Obviously, you can take multiple approaches, and then you can make marketplaces. You can make content, commerce, right? So I mean, all these are large sectors in India. Usually, sort of consumer facing, usually sort of like for example, we discussed in the beginning, it's very hard to imagine pure SaaS businesses in India which achieve large scale. So either they have to be like fintech with their enablers, distribution, this and that, with the tech angle. So those are all sort of large spaces in India. I think we also do a lot of software SaaS, but it tends to be much more global. So those are companies which are building global software companies from India, but there's an inherent talent advantage. I think there are plenty of examples now, again like Freshworks and so many others. iCertis is done very well from India. So I think so that's a theme that we also invest a lot. And I think right now, driven by AI, there's a lot more happening in that space also. So that is a space ripe for investment in our view. So I think we do that combination. So we do India, which is sort of GDP related core sectors, and then we do India to the world, which is more software, which is more across sectors. These days, more AI and stuff like that.
Okay. Uh, I want to go a little deeper on AI, but before that, so there are two things which you look at. One is the TAM, and the second is an A plus entrepreneur or the team which is building it. How do you identify that this is a great team? What are some of those characteristics or some of those decision making frameworks that you use to identify that this is a great team to back?
Again, a very hard thing to do. I think these are the truly sort of the subjective parts of, decision making, which is, hard to parameterize. We've tried like, psychometric test and things like that, but we found that none of it is obviously definitive. They all just give you more inputs, but at the end of the day, so part of it is just having more experience. I think like if you look at me, like I've literally interviewed thousands of tech people, as a part of my global launch journey. So I think I personally feel that I have a view on the Indian tech person, and I sort of can cut to the chase and get a sense of, how capable they are, how good their problem solving abilities are, things like that. And generally our team is very experienced. So I think a lot of it is just experiential. Unfortunately, it's very hard to parameterize it. Some things are obvious, right? Like, is it a well-formed team? Like, for example, two founders are better than one. Three is also a good number. You need to have a number of founders. If you have somebody in the founding team who is more GTM, is a huge positive. Versus ideal founding team in some senses, GTM, product, and tech. It's like other three
Okay.
founders. So I think you get some combination of that, in different founding teams. Sometimes two people might have all three skills. Sometimes one person might have all three skills, right? Sometimes three of them are all tech, right? So even though they look like three, but you only have one skill out of the three, right? So I think
Right. Okay.
so ideally we're looking for some combination of the three. And then I think working history between themselves, like we worry about, the team has just gotten together 3 months back. We've seen enough founder divorces and things like that. I think ability to learn, ambition, right? That they want to do something big. They have the ability to persist over years. It takes many years, to build a business. So I think all those, I think things, you would hear about, we look at, and but at the end of the day, there is obviously chemistry also, right? That can we work with these people? Do they value us? Can we value them? Do we see ourselves in the trenches with them over years and years and years? So I think those parts are also important when you're investing.
What is proof of skills like product tech, GTM, like prior experience?
Basically prior experience, so I think tech is easy, right? If you've been like a tech person for a little bit, right, you would sort of do that. GTM, prior experience, I would say, mostly at this point. I
Okay.
think the good thing in India now is that there are a lot more entrepreneurs coming out from successful businesses, like Flipkart, Paytm, Zomato. So they actually have a lot more skills versus, let's say, 10 years back, where there were much fewer examples of entrepreneurs coming out from these companies. I would say, you know, uh, today the top profile of entrepreneurs is that people who have been employees in these large startups and have seen that grow, and brings these skills to the table.
So, in your model, you would probably miss out the guy like you who straight out of IIT with his batchmate started a business.
We
And
can.
so,
I mean, we do. We just our latest investment is a company just like that. The guy just graduated just now. It's a Delhi-based company. They do biopharma, computational infrastructure, but it's harder for them. I think it's harder for us, I would say, to make those investments. I think we have a particular focus on this particular space right now. So this kind of came through. But it is harder. I would say not just for us, for everyone, all VCs, just because I think, or there are specialized funds like campus funds out there, right, who are doing just this. So maybe we can catch them a little bit later, more in sort of their seed pre-A round versus like the pre-seed type of round, where they're just kind of getting started. So while we do some of them, but it is harder for us, no doubt, because I think our bar is a little bit sort of, we're looking for more.
yeah, I think there's this big gap of perception between the VC community and the aspiring founders, where as aspiring founders, you hear stories of college dropouts building large businesses. But from a VC angle, those businesses are rarely, I mean, they are the exception rather than the norm. Like it would be very, very hard
I
for a
agree.
VC fund to back them.
I agree with you. I mean, it is. I mean, somebody who, let's say, dropped out from college, pitched to us, it would have to be a very high bar for us to invest. Either we just love that space or something, we like, something has to really sort of appeal to us to be able to invest in that.
Okay. The last thread I want to talk to you about is AI and how that is changing the way startups are getting formed. There is this whole set of businesses which some people have somewhat derisively called as wrappers around AI, like a wrapper around open AI. What is your take on that category of businesses?
Look, I think if we just take a step back, then, we were earlier talking about cloud businesses, right? And cloud
Right.
as a term was coined in 1999, cloud.com, and cloud adoption has been happening ever since, right? And I think now we're in 2024, 25 years later. And I think I would say cloud adoption is in the late majority stage, maybe 60% or thereabouts, right? And the big moment for cloud was when internet came, which is 95. So we're actually now almost a 30-year cycle, for enterprise
Right.
adoption. I would say if I look at AI adoption, if we, let's say, take Chat GPT as the pivotal moment where it's available to everyone on the consumer side, then I would say just taking a cue from that, it's easily going to be a 20-25 year adoption cycle. Even if it's quicker than cloud, it's still going to be 20-25 years. There are also obstacles. There are like regulatory obstacles. There's general fear of AI. There is security obstacles. When you put it all together, it's going to be a long cycle of AI adoption. So that's kind of the first thing. So it's not, again, my learning back from like doing mobile sort of field force automation 2001. You're always too early in these things. So I think it's going to be a long adoption cycle. That's the first thing, right? At the same time, in my lifetime of working as a professional, I have not seen as much productivity gain in any other technology. Like even with cloud, it's not like, your productivity gains become 3x, 4x, right? It's actually for all your work increases, and then there are back-ended gains in security, modularity, and things like that. There are no real productivity gains, on day one when you adopt cloud. Similarly, I think when you go back to 90s, automation happened, right? 80s and 90s when let's say Oracle Forms came up, they were real when you move from file to computers, there was a real productivity gain, right? I would say
Right.
that AI productivity gains are similar to that. So today we have portfolio companies which are seeing productivity gains of 4, 5x. Like a 10 people team job can be done by 2 people, 3 people, right? That is like really, most people have never seen that, unless you've been there in the 80s, right? When sort of you were doing basic timesheet automation, things like that, replacing files with computers, and that kind of automation has never been seen. That kind of productivity gain has never been seen by this generation, I would say.
Mm,
So it is very exciting, but it is going to be slow. So our belief
mm,
is that this is a fantastic time to invest in what you would call AI applications. And there's going to be massive adoption over the next 10, 15, 20 years. So as a VC, we can invest, over the next 5 years a lot. I mean, our goal is to invest as much as we can, in sort of AI enablement of enterprises. Now, to your question, wrappers can be of multiple types. So some wrappers are more horizontal, So horizontal wrappers are things like, let's say, security layer on top of ChatGPT, or analytics layer on top of ChatGPT, or some sort of enablement layer, which makes the ChatGPT
mm,
usable, or any of the large language models more usable in a particular context, and things like that.
mm,
I do
mm,
think there will be winners in that, but there'll be few large winners in that. Because enablement is important. Enablement is not easy. I think you can almost equate ChatGPT to AWS or Azure today, right? Like, I mean, it's like an infrastructure. It's becoming commoditized. Llama is providing that now.
yes.
Google is providing that now. Apple is providing that right now. So I think that's a commodity infrastructure, right? So, but enablement takes time. It takes contextual understanding. So there is, I would say, just calling them simple wrappers is lacks nuance, and I think is understating their value. But I think
Mm,
understanding in context and putting a wrapper around that, making it more usable, has value. Then there is, and enterprises are complex, right? Think of again implementing like in a JP Morgan, right? It's really going to be complex, right? They can't just start using Chat GPT, right? It has to be integrated with the 1,000 systems that they have. It has to pass 1,000 checks, right? It has to provide real value. Somebody has to sell it. Somebody has to manage it. Somebody has to run it. So there is a lot of work to be done to empower it. And then there is vertical applications, which are completely vertical, right? So you take anything, and you can just have a AI, like think of CRM, think of financial applications, right? Think of logistics applications, think of any vertical, right? All of them can be redone using an AI first approach, in a far more efficient way. And that is also happening. So these are vertical things, travel, right? And I think all this will happen. So I think if you look at next 10, 15 years, 20 years, we'll see a new generation of winners across the board, in vertical applications. So those are also exciting places to invest into. So I would say both horizontal wrappers and vertical wrappers. I think wrapper is the wrong word, but
mm,
implementations of AI are both sides exciting, and we're investing in both. So we have like
mm,
investment in a company called Promptly, which is an enterprise enablement platform. At the same time, we investment in Decover AI, which is like a legal AI, just taking legal vertical and taking one application, which is evidence detection, investing in that. So I
mm.
think, so we're doing both, but we are super excited about it. We think it's like a major wave, and it's a great opportunity for both entrepreneurs and investors to transform in the next 10, 15 years.
Uh, is this again a game of best GTM wins? Because the cost of building an AI application, I suppose, would be a lot lower than, like, say, 3 years or 4 years ago, if you wanted to build something for the legal community, like a product, versus if you want to build something today, it'll be a lot cheaper, faster today. So, which means that more competition. Uh, so, is it again that, like you said, there'll be few winners? So, is it like a GTM wins kind of?
Yeah, unfortunately, in most cases, in my view is that channel product in most cases in the end becomes hygiene. Like it's very hard to imagine pure product wins. There are few, right? And they happen every now and then, but in general, I would say GTM is where sort of there is a lot more work, and it does win in the end. I mean, let's say there are two startups. One has a stronger GTM and one has a stronger product. I would say the stronger GTM is more likely to win,
Right.
versus a stronger product, because I think, the product spends are also not high. Let's say product needs to be fixed. You can copy your competitor's product, right? It'll cost some money. You can fix it,
Mm.
right? It costs some money and time. Versus GTM is very hard to fix. If you don't have a good GTM, you have no idea what you're doing. Like going back to my EV provider days, right? We just didn't know what we could build any amount. We would not win because we had no clue what is happening on the GTM side. It was not a
Mm.
function of money. So,
Mm.
I do think that GTM is often underestimated and often a bigger point of failure and success than the product itself.
Uh, what kind of GTM strategy do you like? I mean, there is like a PLG and ABM, PLG product led growth, or ABM account based marketing. I believe these are like the two broad approaches in GTM. So, what's your take on?
On the B2B side, I think there are some sort of playbooks which have become sort of clear to the industry at large, and to us as well. So if you're doing large enterprises, which are large ACVs, 100K or more, 50K or more, let's say, then I think it's a slightly different GTA, which is more field oriented. You need like a person to sell. If you're selling in the US, then you need that person in the US. Like in our company Decover AI, we have like one of the founders is based in the US and it's part of this legal world. So that gives us a lot of comfort that they can sort of approach law firms and sell this large ticket product. If it's a smaller ACV product, which is, let's say, 15, 20K ACV, you can sell over the phone, maybe give a demo, things like that. Then that's a different, then the playbook there is online lead generation and then conversion on phone, and sort of
Mm.
then you sort of go from
Inside
there.
sales.
If it's an
Mm.
if it's an even smaller ACV product, less than 5K, then ideally should be all on the internet. That's a Calendly type of product, right? Where you can just purely sell on the internet. And that's where I
Mm.
think the product itself is a big part of the win. I think the GTM is still important, like how you reach out, your CACs and things like that, right? All that, how you bring in virality and all that. But I think the product itself is a big part. But the
Mm.
moment you go from there towards the enterprise, GTM keeps on gaining in importance, I would say.
Mm. Do you see AI making GTM cheaper, faster, easier? Are any of your portfolio companies using
Yeah,
AI for GTM? Like,
they're beginning to. We have a portfolio company called GTM Buddy, by the way, which does just
okay,
this GTM automation using AI,
right.
which is doing very well. So I think there's also a lot of companies making a play in this space because GTM is such a large part of the spend. So for sure, it'll make it easier, simpler, faster, cheaper. So I think all those things will happen. But I think still, GTM still has like a part to it, which is strategy, which is closely sort of related to, the core aspects of entrepreneurship, like product market fit, who to sell to, what to say, and things like that. So while the pace of experimentation should increase, but I think it's still like a indeterminate problem. It's not like you can't say that, I'll get up today and I'll fix GTM. You will sort
Yeah,
of, you
right,
can say today that aaj main night out maar ke I'll fix these features, I'll fix a product, I'll work hard and I'll fix the product. You can still do that, right?
right.
But you can't say I'll
Yeah.
do two night outs and I'll fix the GTM, right? It still tends to be,
Yeah.
indeterminate and experimental. So that
Mm.
aspect stays, and that in some sense keeps the entrepreneurship adventure alive, right? I feel that the day you make GTM deterministic, I think that's a big
Mm.
life altering thing for like a lot
Mm.
of companies and funds out there, because then it's more
Mm.
mathematical.
Mm. What do you see as proof of product market fit? Like, how do you determine this business has found PMF?
So again, I think at different stages of the business, it's different proofs. At a very early stage, like if it's B2B software, then we look at very early need of validation need. Yeah, like the needs is validated. Whatever you're selling, there is a demand for that in the market. So let's say you send out a LinkedIn message, right? Then how many people are responding to you based on your LinkedIn message? Even before buying the
Right.
product, right? But if they're getting attracted, that means that they have that problem and they're looking to get in touch with you, right? The next is whether you can solve that problem or not, right? So right from that the need exists, you have an ability to engage with these target customers, and then you have an ability to solve this problem. And then fourthly, that you can sort of make money while solving this problem, right? So that's, I think, the order of things, I would say. And fifthly, that this is large enough problem, right? That there's a scale to be had here, right? So I think these are the five aspects of it. And I think since we come in early, usually we look at the first one or two. We look at the size, possible size, but we also look at just if the need itself is there. We feel that's where sort of long, like again, going back to my days for AV provider, there was absolutely no need. Nobody's looking for it. It was just like our own. We dreamt it up and kept building it. Yeah.
Uh, there's this popular narrative of grit, but at the same time, grit can also, like, it can work against you, right? When you feel that I need to have grit and make this work, but you're not chasing the right market or things like that. That's always like a hard thing to figure out where to draw the line.
No, it truly is. I think and the other learning is that many times grit is great for the entrepreneurs. It may not be as good for investors. Like I think sometimes, see, what happens is that, let's say if you have a small win, and this is the point of, let's say, where investors and entrepreneurs are misaligned. Let's say a company gets sold for $20 million, right? Let's say you invested in a company at $6-7 million, $8 million, right? And you own 20% of the company, right? As an investor. And let's say the company gets sold for 20 million. And let's say the two founders, they can still make like 4-5 million each, right? 3-4 million each, which is like a very interesting amount of money for them, right? I mean, it's a
Yes.
significant amount of money for them, right? But as an investor, you would not call it a successful exit, because you invested 5 million, you got 6 million back or 7 million back, right? Kind of thing. So grit, sometimes what happens is that entrepreneurs see this opportunity to get a 20 million output, right? And grit might get them there, and it's still a good output for them, right? But as a VC, actually, you see that this is not a good output for me, and hence, there is this kind of conflict as well. So again, I think things are very contextual, and it depends on the vantage point you're looking at it from.
Yeah.
I think if the grid leads to large outcomes, then obviously it's win-win for everyone. But very often, this is what I've seen, that grid leads to smaller outcomes, which are good for entrepreneur, but may not be as good for investor.
So, what leads to large outcomes? If it's not grit, then what are those qualities? Just as an entrepreneur myself, I want to figure out what should I over-index on.
It's not just grit. I mean, grit, like again, if you say that sort of just grit will not get there, but grit is an important component. On the other hand, you don't want to give up at the first opportunity, right? When things are not working, right? So I think grit is important, but it's not everything. Look, the formula again is a combination of many things, but I would say the big thing is finding that space and a viable business model in that space, right? A viable approach to that business. Like you can say, education is a large business, right? But until we found that viable way of approaching that market, which is the current Sanskrit model, we kept on stalling for 5 years, right? It was not going
Right.
anywhere, 5-6 years, right? As even as seasoned entrepreneurs, right? I think same thing with any business that you take. So I think a combination of larger space, and a viable way of approaching that space. I think that's kind of, until you have that, you're still sort of pretty far away from building a large business. I think those two, and until you found it, you have to, I guess, keep looking, and then how to approach it,
And which is where the grit comes in terms of helping
which
you
is where the
find
grid comes in. So
viability.
if your grid is targeted towards that, I think it's a good grid, right? But if your grid is towards, okay, I build this, I have to make this work somehow, right?
Yeah.
And which is, many entrepreneurs feel that way, right? That I have to just somehow. Many entrepreneurs feel guilty if we have taken this money, we should return this money at least, right? And I get that sentiment, but I think it's not about that, right? I think in many cases you have to really think sort of what you really want, what investors really want, and I think if you direct your grid towards that, I think that obviously makes a lot of sense.
Okay. Let me end with one last question. How does valuation work at early stage? You said you invest 1 million to 1.5 million. What is typically the
Yeah.
valuation at which you invest, and what determines that?
It's very market driven. So I think I would say, like for us, for example, we are looking to take, our goal is to try and take like a double digit ownership close to 15%. Basically, that's our fund
Okay.
model. We're looking to basically, and so we reverse work. So we try to write 1.5-2 million. that gets us close to that kind of ownership. So by corollary, we're looking at companies which are in that 10 million, 12 million post money kind of valuation. And that gives us a certain kind of company. So we generally stay true to this track. We can go a little bit up, we can go to 15, 16 sometimes, we can go a little bit down, 6, 7 sometimes. But we stay in that sort of, and I think most funds are like that. So they usually have like a model that they're trying to solve to. So that's ours. And I think the seed valuations in India are in that range today. I would say between 8 and 12, 6 and 10, I think in that range. And in early stage, honestly, it doesn't make a whole lot of difference. Like in the sense, let's say a valuation is 10 million versus 12 million. If we have to take 15%, the decision for us is whether to write 1.5 million, 1.6 million. You know what I'm saying? So
Right.
it's not a huge decision. If you like the company, you'll write 1.6 million, right? And it's a $75 million fund. So it's not like by saving that 100K, I'll achieve something, right? So actually the valuation is a much bigger factor many times in entrepreneurs' mind than in VC's mind. I think for us, we are more solving to, can this be a large one? Can we get enough ownership? I think. And so that's why, that's how the algorithm works.
But you said that because you're looking at companies which are valued between 8 to 12 million, so you get a certain type of companies coming to you. What are the type of companies which are where there is a legitimate reason to value them at between 8 to 12 million? Do they need to have a certain ARR already, or like what?
Usually in the SaaS space, these companies are 1 to 2 year old, some, let's say 100K ARR, let's say if you take the next level, which is pre-seed, a company which is just starting, right? Fresh entrepreneurs, they're usually raising at like 3, 4 million, 5 million, like an angel round or a micro VC round, right? So I think raising 3, 400K, 500K just to get started, right? So that's kind of usually the first level in India these days. And then the same company, when it has existed for 1 or 2 years, right, has some early sort of proof point, 100K ARR, 200K ARR, I think that's the right time for a fund like us. I think the consumer companies are a little bit more complex, consumer internet content, because the metrics are different. But I think SaaS is easy to understand. I think that would be the typical range.
And you've invested in consumer internet and content kind of businesses also.
Yes, yes.
What?
Consumer internet logistics, all kind. Like we did Beto, which is like a diabetes care consumer internet
Ah,
platform.
okay.
So a
Healthcare.
bunch
Right.
like that. Yeah. Bulbul, we
Yeah.
did social commerce, didn't work out, got sold to Good Glam Group. So a bunch of that.
Okay. And in content, what have you done?
We
Does
actually have
content
not
work
done
for
much
business model?
content. We have done very little
Right.
content. We've done gaming, so we did, which is also considered part of content. So we've done Bombay
Right.
Play, which is like a gaming, casual gaming studio. We've done BuyStar, which is another gaming company. So we've done gaming inside content, but we have stayed away from, let's say, the share chats of the world and sort of the real sort of content type of plays so far.
Mm, mm, mm. Okay, okay, okay. Amazing. Thank you so much for your time, Rajul. I took way more than what we had scheduled for, but I was having so much fun. I couldn't stop asking you questions. So thank you for doing this.
No, thank you. I enjoyed the conversation, and I hope it's interesting to people. I always think that my entrepreneurship journey started from a conversation that I overheard from Newgen founder. So I always think that hopefully someone will hear
Oh,
this and get
yes.
inspired, and hopefully we'll have more entrepreneurs. So,
That's amazing. That's amazing. That's a good way to end the show to remind me about that first conversation. Yeah. All right.